I don't think there's a lot of edge to be had in predicting when this kind of like DAT mania or whatever we want to call it will like start to lose steam, because most of it is inherently rooted on just like strictly irrational behavior of people, having this conception of I can put, $1 in a box and like it will be worth, $1.20. And then like, I'm just going to keep doing that. And then like, eventually it's going to be worth 90 cents at some point.
People like to put things in boxes and it makes them, comfortable. But in reality, like that's not the way any financial market works.
There's like very clearly different segments that act like very, very differently, which is why you've seen for the past like 2 years in a row, Bitcoin just like keeps going to all-time highs. And like most of crypto Twitter is like depressed most of the time because like they don't own the Bitcoin.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. Earning yield on stablecoins just got smarter with RE protocol. Get up to 16% APR plus points through regulated insurance backing and ETH basis strategies with no lockups required. Deposit USDC, USDT, or DAI to start earning stable yield and points today at re.xyz, re.xyz. Mantle is pioneering blockchain for banking, a revolutionary new category at the intersection of TradFi and Web3. Follow Mantle_official to learn more. Heads up, everyone. We've got exciting news. Bits and Bips, our macro meets crypto show, is officially spinning off into its own podcast feed, YouTube channel, and X account. If you've been enjoying the deep dives into interest rates, monetary policy, and how they intersect with the crypto markets, make sure to follow Bits and Bips wherever you get your podcasts, on YouTube, and on X. You'll find the links to YouTube, X, and other podcast platforms in the show notes. If you're watching this, there's a QR code on screen. We'll be posting here for a few more weeks, but starting in September, Bits and Bips will launch on its own feed. For now, we will publish longer clips from the show on those accounts. Remember, go to the show notes now and subscribe to Bits and Bips. That's Bits +Bips, spelled BIPS, on YouTube, X, and wherever you get your podcasts. I'm here with Peter Hans, partner at Hack VC, and Jon Charbonneau, co-founder and general partner of DVA. Welcome, Peter and Jon.
Thank you, Laura.
Yeah.
Great to be here.
Heads up, everyone. I can't be on screen again today, and I'm so sorry about this. We will get this sorted in due time. All right, let's first start our discussion with DATs. Everybody keeps saying this trend is overdone, it's over, and yet, because I think all trends in crypto must go on until they're truly dead, the trend appears to still be going. On Monday, Sharps Technology said it's raising $400 million of SOL to create a Solana DAT with investment from Pantera and Parify. So we're definitely not in the last innings yet. I mean, those are big names. I also saw Rob Haddock of Dragonfly Capital retweeted a screenshot of the aggregated MNAVs of all of the DATs by crypto. So it's like kind of like what the MNAV is for all of the ETH DATs and all of the Bitcoin DATs, etc. If you look at the screenshot, it shows that the general trend is downward. But then he wrote, all these pitches about getting to market quickly, trading at a high premium, diluting shareholders massively, etc., are essentially all dead on arrival at this point. If you want one of these to be successful, you need a differentiated story that's aligned with the ecosystem of your asset and can accrete value over time that's beyond just capital markets alchemy. So just wanted to hear from both of you what your perspective was on what's happening in the DAT market. And Peter, why don't we start with you?
Sure, absolutely. And before I start, I just need to read a quick disclaimer that's in addition to my large and sometimes noisy dog, so apologies about that. But as an important disclaimer, the views shared are my own. All such views are for informational purposes only and do not constitute and should not be construed or relied upon as legal, business, investment, or tax advice. So, so look, in terms of where we are in I guess the DAT cycle, clearly we're not at the end, I guess, at least as evidenced by the announcements. I mean, we'll ultimately see where everything gets done. But, and the one thing I will also say, Laura, is like, I don't think this is necessarily unique to crypto. Like I've been in financial markets for a long time now. And, you see this constantly, like Wall Street loves to, rinse and repeat for any type of vehicle that it feels like it can make money on, right? From mortgage REITs to now, digital asset treasuries. So I think there are a lot of potential deals in the market for varying assets, and obviously we're seeing, I guess, objectively speaking, successful ones across Bitcoin and ETH. So Solana is kind of the logical third in tow, but ultimately, it's very tough to say like how it'll end, because personally, and again, this is my opinion, like I just don't necessarily know that there's a massive need for a vehicle like this when you have alternatives of owning spot, owning futures, owning ETFs. Ultimately, I think the back end kind of like infrastructure of financial rails will all congruent into chain-based custody and rails. So I just don't necessarily know what the ultimate objective is, and that's usually not a great sign, but I get it. I get why people want to issue them.
John, what about you?
Yeah. I've been joking about it lately. I thought I was done kind of spending time on a lot of financial engineering and structured products when I left banking a few years ago, but that has come back lately. So that is what I'm spending time on the last few days looking at. You kind of just have to at this point to understand the market, at least to some degree. We haven't participated in any of them, but it is driving most of the flows in the market. So you just need to have some high level understanding of what's going on here. My general view on them is, I think most of them are, like, kind of as you alluded to in the intro, like most of them kind of are dumb. They're a little bit cash grabby. This is just a way of, we're going to put in our assets, see if we can sell this thing at a premium to people. A lot of the froth around that is starting to go away, at least on the margin. It's much harder to just raise a new vehicle like that. People just aren't receptive to that anymore. That being said, for at least the medium term, I would say there is a genuine use case for these, which at the end of the day really is just mostly regulatory arbitrage that I think will close over time. So, the simplest examples are, if you're a TradFi investor and, I'm not going to be going on chain to go buy this asset, or I don't even want to go get an exchange account, you're normally buying ETF. Practical reality is, like, most of these assets they just simply don't have ETFs. So even just for getting vanilla exposure to a lot of them, it's just like actually difficult to do that for a lot of people. I think that gap is going to close over time as it becomes easier. We're going to get, better ETF frameworks, more assets will get ETFs out of crypto. Similar of just a regulatory just kind of issue there is a lot of the current ETFs, they're still pretty hamstrung on what they can actually do with the underlying assets. And so to the extent that you have an asset that generates a meaningful amount of yield, or you would be diluted away, which, proof of stake assets like particularly ETH and Sol and down the list will have. If the ETFs can't stake, that is a actually meaningful competitive advantage for some of these vehicles. If you're basically just treating them like an asset manager at that point of, you're telling this manager, like, hey, I trust you to go generate yield in a way that I'm not able to, and to balance this portfolio and just manage your risks. So if, some portion of this should be staked, maybe some portion of this you put into DeFi, and you're using different strategies, and you get some risk adjusted yield that I'm comfortable with. ETFs currently just they just simply can't do that. And so to the extent that some of these are well run and you have a good manager, and there's still just these are the best available vehicles for that at the moment, they still make sense. A lot of the MicroStrategy stuff has really just been, the business is selling structured products to people who just want a certain type of exposure to the underlying. They want to make certain bets on volatility of where Bitcoin is going to go. So they're, selling converts and just different ways to get exposure to it. But even a lot of that is, again, it's a structural regulatory arbitrage, which has even reduced once IBIT went live, and you have options and stuff like that on there. You just don't need MicroStrategy to get a lot of these exposures anymore. So for better or for worse, it's a game that you kind of need to play as a major crypto asset, is what it seems like right now. And I think that's kind of the vibe that it seems like out of the Solana side right now, is they were kind of very slow to it in general from the top, and they saw how much traction it got on the ETH side. And a lot of people start to realize, this is the thing that we need to do now. And so there's a little bit of a catch up there, and they are the next natural asset. So that's why you're starting to see some of the big ones coming out next for Sol. The main thing that people on Twitter have been talking about the past couple of days, I guess probably worth going into, is just some of the structure of these that looks different, and what is actually going into the vehicle. Generally, if you're just as an outside investor looking at, what is the most positive thing for the underlying spot asset, is you would like to see all of these vehicles just be all cash contributions. of, simple example, investors put $1 billion into a box and the box says, I'm going to go buy $1 billion of ETH or SOL or whatever. You're going to see some more like that. In practice, a lot of them, particularly the earlier ones, have been much more heavily in-kind contributions, or at it's generally been a mix of them, where it's a lot of in-kind contributions and then some portion of cash. Where for these big ETH ones or SOL ones or whatever, like you see the big investors, and then they're putting in $500 million of ETH or whatever asset to go in there, along with some cash. So the in-kind contributions are they're effectively just neutral from the outside. This is no new buy pressure. They're just putting the money that they currently have in a box and doing stuff with it. And then the part with that in particular that people have been talking about with Solana is at least some of these stats, definitely not all of them, and some of the bigger, I think, more interesting ones are some of them have been putting the locked SOL in there. That was particularly from the FTX estate sale. So people have wanted to contribute that into these vehicles in kind as well.
And which ones are those? Because I was going to ask this question. I saw Vinny Lincoln tweeted this morning. I hope investors realize that most of these Solana DATs include FTX locked SAFs, which are being contributed into the DATs with little to no discount to give those holders earlier exit liquidity in the form of DAT stock. So can you name names?
I actually don't genuinely remember know the names of the current ones that are doing this. I will say the ones that are, I just I would definitely not assume that all of them are going to be like that. The ones that are more reputable and more interesting and will have a lot of good backers and I think are likely to be more sustainable are just they're just not going to be doing that. It's going to be a lot more cash contributions and running strategies that actually make sense to generate yield and manage the funds efficiently. I think that you will see good ones. I genuinely just I don't know the names of the ones that were doing the locked ones because we just never seriously looked at any of those deals.
And I heard you say that on the Thread Guy episode, and you said that you guys haven't invested in a single one. And is it literally just because you don't find this kind of financial engineering interesting, or what is the reason? Because, I've seen other investors say this is the only one I did for this or that reason. But why?
I mean, part of it is probably realistically just a time spend and where can I produce an edge kind of perspective of, I don't think there's a lot of edge to be had here as an investor in guessing where these are going to go. And frankly, I just don't want to spend my time on kind of random financial engineering anymore. And also realistically, I think most of what people are contributing to is they're just putting in-kind assets that they have into a box and kind of hoping that people go bid this box up to be worth more than it is. That's just not a very interesting game for me to play. I even from a just selfish financial perspective, my guess is that once you start to get these things to actually unlock, I don't think that you're going to be able to see people actually exiting most of these in size at meaningful premiums. Where they're just not actually going to be profitable. And it's just a game that I don't want to play. The ones that I would that I've somewhat more seriously considered actually interestingly is some of the ones that put locked in for the same reasons that as investors, we looked at locked token deals at any point, which is just very often the way that we decide is the best way to get exposure to an asset is, if this is a thing that we're convicted and we want to hold for a long time, buying the asset locked and at a discount can make sense. And so that is actually the upside of these vehicles that are putting in the locked tokens into them is I understand why people have a very negative perception of them of this is just the investors getting early liquidity and they just want to dump and get out, which in many cases is true, I'm sure. But at the same time, it is actually just opening up access to these deals that normally a lot of people just don't see. I mean on the locked SOL one, we saw these deals at the time, we just chose not to do them. But there are other DATs where maybe you wanted to get exposure to this asset and they're contributed locked tokens to it. And then you just decide that this is the best way to get exposure to that asset because you can't buy the locked deal anymore. This is a locked deal that happened previously. And this was really just a way for them to kind of broaden access to those kind of deals to other people. And then you get a better free market rate of what should the discount be actually on these. Because the ones that are putting in discount locked tokens into the box, they should trade at a discount to NAV. We'll see if they do that, how closely people actually look at these, at least early on. I'm sure that they will get there. But to the extent that they are trading at reasonable discounts, those actually are potentially attractive vehicles where we're happy to take the liquidity risk over time.
You think the actual like liquid DAT should, or that the in kind should be contributed at a discount
but both. But yeah, but like we'll see what happens for them. But I mean, it like the simple kind of example would be, I mean, like a foundation or whatever that like has locked tokens or investors or whatever. Like normally those deals are just like they're syndicated to a handful of VCs, and maybe the VCs price that at like it should be at a 25% discount to the market for this duration, or 40% or whatever. And when you broadly syndicate it to the market, like that premium probably should compress as you give access to more investors, but it should still be a discount. So maybe instead of 25%, the market, as you brought in access, like should even out at 20% over time. In practice, I like people I'm sure are going to like shove a bunch of stuff in here, like not really talk that much about the fact that this is locked up for a long time, and just like treat it like it's the same. And then people will buy it at 1 times NAV and then realize later on, like, oh, this should be trading at a discount. So I definitely think a lot of the games in practice are going to have negative effects. But there is like at least some theoretical use case for these. The positive thing as a holder too is, at least potentially, is this does like potentially remove sell pressure if you are a liquid holder for these. Like, I mean, this is a point of concern for whether it's VC tokens in general that have like a lot of investors, or SOL. Like people were concerned of, oh, everyone who bought the FTX estate sale, they're going to unlock and they're just going to keep selling. This is potentially, if you're putting them into a box that is going to be a stickier capital base, and now those VCs just like are not overhead sell pressure that you're going to get for the next few years. That is like actually potentially positive if you are a liquid token holder, even if you're just like not participating in this, you're just removing sell pressure.
The one dynamic of these vehicles, of why they potentially make sense longer term, is analogous to like mortgage REITs or any other like actively managed vehicle whose underlying business is to hold assets. And the entire business there is predicated on those, you know, the underlying stocks selling at a premium to NAV or trading at a premium to NAV. They have to, because if they trade at a premium to NAV, then when you go out and raise additional capital, right, you're raising that capital at a premium to book value, and you're taking that capital and going and buying assets at par, right? If it's bonds or spot prices, right? So you're immediately buying in a way that's accretive to the book value of the business, right? So to the extent that these can trade at a premium to book value and consistently tap secondary markets to raise more capital and then purchase whatever token, right? Ultimately that benefits the underlying asset because it's accretive to the book value, right? And these would trade, I would imagine, like NAV book value. There's somewhat synonymous in this case, but it would be accretive to the book value, right? To the extent that they trade below NAV, now all of a sudden you get in a situation where you can't raise additional capital because it's dilutive to book value. So every time you would raise money, it actually hurts your book value more and more and more, right? So it's these cycles. Now with like mortgage REITs, it tends to follow, independent of credit risk, it tends to follow interest rate cycles, right? Of like NIM compression or expansion. In this, that's not really the case because, you know, at least like Bitcoin, like you're not really earning yield. I would imagine on most of this stuff. Maybe you are if you're doing, you know, something. I don't know. Now, I read in one of the Solana ones, and I don't know a lot about, you know, like, you know, participating in them. But, you know, to the extent you can buy some, you know, from the Solana treasury at, you know, 85% of par or something along those lines. And like, yeah, technically that's accretive to the book value, but like, how long will that continue to last? That's tough.
And Peter, I believe, correct me if I'm wrong, that Hack VC has not invested in any of these DATs. Is that correct?
I can't comment on like our investments or anything like that, but we haven't announced anything to my knowledge.
Okay, yeah.
We're an early stage infrastructure fund, so read into managers. So read into that what you want.
Oh, okay. And I'm sorry. So like, if I were to ask you like why you haven't well, okay, you're just saying it's because that's not what you do.
I mean, we invest in, you know, seed and early stage,
okay.
You know, venture and Web3 infrastructure.
Got it. Okay. Well, so let's just talk about how these Ethereum DATs have been doing, because like generally it's sort of like ETH and TradFi overall is doing really well. It's like not only that the DAT trend was going strong for a while. I think like now it's just there's a little bit more, shall we say, of a measured response or maybe like a more knowledgeable response. But even like on Monday, the Ethereum ETFs had greater inflows in them than, you know, the Bitcoin ETFs did. And I saw actually also on the Blockworks debt, pages that trading volume of Bitcoin and Ether debts are roughly equal at about 3.7 or 3.8 billion, whereas like Sol debts the trading volume is about 444 million. So I wondered, what's your take on why TradFi seems so interested in Ethereum right now?
You want to kick it off, John, or you want me to give my thoughts? Yeah, go for it.
Because I know, John, you're not. you don't think that this is smart, but anyway.
Well, I think it's a reasonable trade. I've tweeted that for a couple months that I think this is a very simple to understand momentum trade, and that's why you're seeing a lot of TradFi type momentum hedge funds come into this trade because it just makes a lot of sense. You have an established asset that was oversold, has a lot of positive flows, and frankly has a good narrative right now, particularly with stablecoins. There's a lot of FOMO, particularly after seeing Circle. Investors just want areas where there's a lot of growth. Stablecoins are the simple one right now, and people look at the simple pie chart of, for example, all this, most of the stablecoins are on Ethereum right now, and so you can make a simple growth bet, and there's just a lot of flows going into these things, and it's a catch-up trade to Bitcoin. And to the extent that goes further out, it goes to Sol, it's going to be the same point of it's going to be momentum trade, and they're going to be TradFi speed running the same kind of arguments that all the crypto people made over the last few years is yeah, ETH is great. But then once it's had its run, then you start getting excited by oh yeah, the other one's the fast, cheap one. And then people start making the exact same arguments that all the crypto people made. And realistically, if it gets there, it's just based on how far does this kind of flows game that the DATs keep having flows come in and you can raise good ones, keep going. Because if it keeps going, my assumption is it will roll out to Sol. To the extent that the market keeps going up, ETH is staying at a high value. Sol is the next obvious candidate. If you get good DApp backers behind this that have a lot of capital, have good reputations, are actually going to run these well, for the same reason that crypto natives are buying Sol for the last few years, you probably start to see the same trend happen. The difficult part is just it's just so hard to predict. I don't think there's a lot of edge to be had in predicting when this kind of DApp mania or whatever we want to call it will start to lose steam, because most of it is inherently rooted on just strictly irrational behavior of people, having this conception of I could put $1 in a box and it will be worth $1.20, and then I'm just going to keep doing that, and then eventually it's going to be worth 90 cents at some point.
The fact that you use that actual language reminds me of SBF.
Yes.
Yes.
Because that is exactly what it is. I've made that joke before. Literally this is what that sounds like. Because that is the game that's being played in large part right now. And it is reliant on that. And to the extent that people keep buying it at a premium, they can keep issuing new shares, they can keep raising more capital and keep buying the underlying. But when that unwinds, it unwinds. And it's purely speculative driven, and most of it's irrational. So it's pretty inherently very difficult to predict when exactly is that going to lose steam. A lot of people thought it was about to be dead a week or two ago, and then it wasn't, and then we're cutting rates, and so party keeps going. It's anyone's guess, how far this goes.
Yeah, here's a funny story, which is I have a good friend from Vienna, and we met at grad school in New York, and at some point, he was like, "Oh, cupcakes came to Vienna 6 years after they were all the rage in New York." So I feel what you're saying is TradFi is Vienna, and what happens in crypto is New York or something like that. He was all the major trends that happen in New York come to Vienna 6 years later. But anyway, yeah, Peter, what do you look?
Yeah.
What are you thinking when you see all this interest in Ethereum?
Oh, well, I guess first, it could be the opposite, right? In terms of, Vienna could be crypto in this case, because I think financial engineering, new structures, I've seen this story so many times in so many different markets, right? From, junk to mortgage bonds, right? CDOs, structured finance, right? That's what this is, right? So it's just, I think it's entering new markets with new assets and new players who maybe haven't read this book before. So that's, it's a remake. It's like remaking Karate Kid. But in terms of ETH, look, I think markets are narrative driven. All markets nowadays are narrative driven. It impresses me how the narrative on ETH changed on a dime, right? This year, right? It was from it's a dinosaur, it's dead, it's going to zero, to I think people like Tom Lee, and I think there's an understandable there's an understandable narrative around ETH that makes sense that, people have been saying off and on for years, right? About it being kind of like, and I think it's very understandable to a lot of traditional investors who maybe aren't like global macro by nature. Like, Bitcoin is a global macro asset. Most traditional investors are not global macro investors. They look at fundamentals and earnings power and models, right? Things that like Bitcoin, you can't do that for. There are probably some people who disagree with me, but like I certainly don't know how to do that. ETH you can to an extent, and you can at least convince yourself of a narrative where it is the world's settlement layer in some capacity. And if that is the case, then what's it worth? And the valuation of ETH is also extremely reflexive, right? So it's like as more value ascribes to ETH, the underlying enterprise value of the chain goes higher. So that's why it moves large, I think, in both directions because of its reflexivity.
Yeah. All right. So in a moment, we're going to talk more about stablecoins, by the way. We're going to talk about them because there's a lot we want to cover in this episode. But first, we're going to take a really quick word from the sponsors to make this show possible. Traditional stablecoin yield often comes with hidden risks or long lockups that limit your flexibility. Re changes that with 2 transparent, regulated options that earn both yield and points. Re-USD offers up to 8% APY backed by ETH basis strategies or treasury bills, perfect for treasuries and market makers who need liquidity without underwriting risk. For higher yield seekers, Re-USDE provides up to 16% APY, backed by fully collateralized U.S. insurance programs, including homeowners, auto insurance policies, compensation, and more. All assets are transparently reported on-chain and written against regulated counterparties for maximum security. Whether you're managing a DAO treasury or seeking uncorrelated yield opportunities, Re delivers stable returns plus points without the volatility. Start earning today at re.xyz, re.xyz. Mantle leads the establishment of blockchain for banking as the next frontier. UR is the access layer that transforms Mantle Network into a purpose-built vertical platform, the blockchain for banking, that enables financial services on-chain. UR unifies and vertically aligns Mantle's focus on payments, trading, and assets. MI4, METH protocol, functions FBTC, supported by developer grants, ecosystem incentives, and the industry-leading distribution platform through the UR app, Reward Station, and Bybit launch pool. All economic activity within UR will be captured by Mantle Network to further drive value to token holders and establish its significance in blockchain for banking. Follow Mantle_official to learn more. Heads up, everyone. We've got exciting news. Bits and Bips, our Macro Meets Crypto show, is officially spinning off into its own podcast feed, YouTube channel, and X account. If you've been enjoying the deep dives into interest rates, monetary policy, and how they intersect with the crypto markets, make sure to follow Bits and Bips wherever you get your podcasts, on YouTube, and on X. You'll find the links to YouTube, X, and other podcast platforms in the show notes. If you're watching this, there's a QR code on screen. We'll be posting here for a few more weeks, but starting in September, Bits and Bips will launch on its own feed. For now, we will publish longer clips from the show on those accounts. Remember, go to the show notes now and subscribe to Bits and Bips, that's Bits, +Bips, spelled B-I-P-S, on YouTube, X, and wherever you get your podcasts. Back to my conversation with Peter and Jon. So let's talk about all the stablecoin stuff. There's so much. Obviously, we have Stripe launching Tempo, Circle launching Arc, Tether launching Stable, which is exclusively for USDT on its own EVM-compatible chain, but also Plasma, which is a Bitcoin sidechain that will be more stablecoin issuer agnostic. There's a whole slew of other stable chains, Codex for USDC, One Money. I'm sure there's more that I missed. But let's just talk about this concept of, a stablecoin-focused chain, a stable chain. Why is that necessary? What is it that can't be done on a general purpose blockchain that, requires a chain devoted to stablecoin transactions? And either one of you can go first.
I mean, look, I think simplistically, the way I personally would think about it is, if I'm dealing in dollars, let's just say, it can be any like sovereign currency, right? Just like I swipe a credit card and I pay interchange fees in dollars to Visa and MasterCard. If I'm sending, dollars to some other wallet address, right? I want to pay gas, which is the equivalent of an interchange fee, in that same asset, not ETH or Tron or something else, right? So I think simplistically that makes a lot of sense to me.
I'll run through the list because it's something I've been spending more time thinking about lately. I'd broadly put them into a few buckets. One is I would put into the bucket of, to that point of like a specific stablecoin, the like loosely affiliated with a particular issuer ones. So for USDC, I would say like Noble and Codex are generally like pretty like circle aligned. And then for USDT, it's been like Plasma and Stable are the ones that are more like Tether aligned. For those, I'd be curious to hear your take on them. I believe you guys had invested in Stable or Plasma, I believe Stable. I just like haven't seen any meaningful differentiation from these of like they're basically just all EVM chains. And you can do stuff like gas abstraction on existing general purpose chains. The probably like direct thing on that is like, I mean, it's still like not at least the standard that it's being adopted everywhere, but like you can do it at a technical level. The one that is like very directly, it's not even like affiliated with the issuer. It's literally the issuer is obviously Circle is doing ARC. My guess is they could pull some interesting levers from being the issuer and like trying to drive business there. But even them, it's like I haven't seen any technical unlocks on the chain. It's like it's another EVM chain, which is like fast and cheap, and they don't actually own distribution with end customers. Like their partners like Coinbase really own the distribution, which I mean, crypto Twitter has seen a lot of when they ripped Circle apart over their like IPO filings. That like Coinbase is making all the money. But Coinbase like does have the distribution that matters for being able to drive activity to the chains. And that's not something I've seen from those. Stripe is the one that is like of the big corporate ones and in this group, like the one that is at least intuitively the most interesting to me. We don't like have many details. It's a pretty like rumored they're going to do it thing. But on that point of distribution, like Stripe is obviously just a very large organization with very good product instincts that like really does own the end customers right now. And so to the extent that like they want to push their own blockchain instead of, using Base or Solana or whatever on the back end, and like their customers are using it, like it will be successful if they want it to be. The question is like how much value do they get out of that? Do you actually earn a lot of money from pushing it there instead of Base? Do they potentially derive value from like just being able to control the stack better and being able to give a better product than they would otherwise be able to? TBD. The main things that I think that you probably need for these are it's distribution. Like, does your chain actually have like meaningful end customer distribution, like and or technical unlocks? I just like haven't seen a lot of particularly the latter on them. Like the last one, I mean, like bias on this one, where investors in them, it's called Pay. People probably saw them like last week of like they released like this, private stablecoin credit card where like you could spend stablecoins and even the issuer like Pay and Visa, like they can't see your on-chain balance. But that was you still see your Web2 payments as with any card. But like it's a private chain, you could send payment transfers. Like the app looks like a Venmo. So trying to like build distribution in that way, and then obviously just like actually being a privacy first chain, because that is the thing. Particularly like privacy as a broader trend, but like particularly for stablecoins, my gut is like that's going to be a like pretty meaningful differentiation point of how did these chains approach privacy going forward. Because this is the thing which I think like the entire industry has overlooked over the past few years, because I think it was like easy to kind of brush away all the privacy stuff when like we just have a bunch of early degen on-chain users like whatever, it's fine, I have pseudonymous wallets. Like you just like you actually can't get normal users and institutions on like fully public blockchains. And so the question of like what is the right level of privacy abstractions of, is it doing confidential transfers, which chains like Solana and stuff are like trying to experiment more with right now. We just haven't seen a lot of adoption. Is it more full privacy? Is it like select disclosure? Like what is the right level of privacy? I think this is like actually going to matter a lot when you try to like actually just get normal consumers and businesses on chain. And so that will like probably be a meaningful differentiation point. That's the main thing that is like I just haven't seen people like really pushing on a lot. But that would be my guess of that is the main unique factor that like actually could differentiate some of these stablecoin chains. Like you would never use a credit card or whatever your normal finances or as a business put all of your stuff like your real operations on chain if it's fully transparent. Like you obviously can't do that. Like it's just like a very obvious thing when you like say this to anyone outside of crypto. It's just like, oh yeah, of course. And if you like look at the surveys of, why is your TradFi institution like not doing more stuff on chain, very consistently, like you see privacy and transparency like as like near top of the list of like, this is a reason we just like literally can't do this very obviously. I think this is finally going to come back now.
Yeah, this is exactly why I was always confused about the Venmo thing with the payments. Like I don't know. I probably changed it from public to private at a certain point, but like that was probably obviously it was when I got into crypto, but like I don't even think before then I had that many that were because I just wasn't using it very much. So I think I didn't think about it. But like, yeah, it's now seems so obvious. How does Pay do this while also being compliant? Like what's their way of handling that bit?
Yeah, so the way that it like is basically going to work there, so it's a UTXO chain. It works pretty similar to like something like Zcash, or how like transfers will work on like Aztec at a pretty high level. The way that like when you're sending a transfer on your phone, like from like one person to another, is you're actually generating a ZK proof on your phone. So when I'm like creating a transaction link to like send you $1, I'm creating the ZK proof on my phone. And so what I'm submitting to the network is just hashes. Like the sequencer in the network doesn't see who the addresses are, what's the amount, what's the asset. Like you don't see any of that. To keep a minimum level of compliance, the tweak that you can do is enabling what they call transaction lineage, which is you still keep all the transactions fully private. So when you submit a transaction, you still never see the addresses, the amounts, the assets, or anything. But you will see the path a note takes. A note being like it's like a private UTXO. You'll see the path that it takes through the network. So you will see a hash of like this note led to that note, led to that note, led to that note. So as an outside observer, you'll just like see this linked list of hashes, but you won't know like who those individual transactions were. But that gives you enough for when you like identify like a poisonous route of like, let's say like someone like North Korea hacked funds on ETH and they bridge it into Pay network and they like send it, a few different people, a few different transfers, and then you code to try to offboard that to Coinbase or whatever. They'll be able to very directly just like see on chain. This UTXO, this note that you sent me, like this traces back to that hack. Like I'm not going to accept that. They won't see any of the details of those transactions along the way of like who the counterparty is in here, what the amounts that they sent. But you'll be able to very directly tell like, this note descended from here. Like I won't accept this. These are claimed funds from someone else and they would accept them.
So this is like a Bitcoin style chain.
It's UTXO based. Effectively, pretty much all the privacy chains use UTXOs. Whether it's Zcash, Penumbra, Aztec, like all of them use UTXO derivative styles in at least some form.
Okay.
To generally do private transfers. Like the account-based model is like generally just kind of difficult to work with for privacy and tends to leak data. So most of them like incorporate UTXOs to some extent, varying extents. It's like harder to do smart contracting and stuff, but yeah.
Okay. And then just to understand like how decentralized is it?
It's a typical like L2 model of they currently run a sequencer. Currently, the DA is centralized, and then they'll start posting it to Celestia DA, I think in like a couple of weeks pretty soon.
Okay. And wait, I'm so sorry. So it's a UTXO chain that's on Ethereum?
The bridge is actually on Polygon.
Got it.
Basically the same reason that like Hyperliquid, I mean, people argued it was like an L3 or not. They put their bridge on Arbitrum because you just need a place for people to deposit USDC. That's the only function of what this is an L2 of is it's a bridge contract. And so for Pay, it's all USDC. And it's just like, where can we put like a deposit contract on an EVM chain that all the CEXs support with USDC? And whether it's Arbitrum or Polygon or Optimism or Base or whatever, it doesn't really matter. It's just a place for people to deposit USDC. But the contract's actually on Polygon for that reason. It's just cheaper than Ethereum.
Got it. Okay, that's really interesting. Yeah, I saw that news last week. So we kind of talked about some of the different features of like a stable chain, but then, as you mentioned, distribution is going to matter a lot. So, Stripe obviously has an advantage in that regard, but also they're like, they're kind of an incumbent in certain ways. So they'll have to like disrupt themselves in some fashion. And on top of that, they're not like crypto native, whereas like, Coinbase's, you have Tether entering the US market. By the way, I like, it just feels to me, at least at this moment, that Tether will be pretty dominant, I think, in anywhere that's not US essentially or something. But anyway, point is, so however you want to divvy up the market, talk to me about what go-to-market strategies you think will kind of make or break these different chains or coins, so stable coins.
It's really going to depend on, I mean, just like, I don't think there's going to be one chain. I do think that they are intuitively going to go after different segments. I mean, the chain that Stripe is building, I'm assuming it would seem highly unlikely that this is not the chain in practice that like people in South America are going to be using for everyday payments between each other and like saving. My get that's just like probably not their target market, or various like other Eastern countries. Like that is a very strong target market for Tether. That's probably going to continue to be the case. And so different people are going to take different distribution strategies in there. Stripe is going to be probably like very effective at taking a lot of the more institutional and B2B type payments, which is very much just like, these are the customers that they're already serving, that like they're going to be very good, I assume, at like winning a lot of those use cases. And so then the question is, how much do they want to actually branch out from there? And we actually like, it's not entirely clear, like what is their strategy for this chain going to be? How much of it is going to be, this is just a simple backend for us to control, you know, all of the stuff that we're already doing. And just instead of doing these transfers that we were doing for like stablecoin financial accounts for like Base and Solana, you know, we just use our chain instead. Maybe it's that. Or maybe they do decide to broaden this out as part of like their broader crypto strategy, and they want to expand into more consumer use cases. They want to get DeFi stuff on there. Very TBD. I mean, you can see it going either direction. My guess is certainly, at least early on, it's like probably going to be pretty more like focused at what are their core use cases, and kind of like catering to those types of customers. And then other people will go after different customer segments, whether it's like crypto natives who want to put their consumer finances on chain, or who want to like do DeFi stuff with stable coins, or people who want to save in, you know, non-US countries in dollars and just like get better access to that globally around the world. So my guess is just different chains are going to take different strategies of like the different types of distribution. So you'll probably see a wide range of outcomes, and different ones will be successful probably in different verticals.
Yeah. I think like if I think about Stripe, it's sort of like, if they play their cards right, they'll onboard users into the behaviors that they need to learn to use stablecoins. And then they could branch out into more like a Venmo type space if they play their cards right. You know, but like if a Coinbase plays its cards right, then it's going to take its kind of like lead in the fact that they already have a chain going to, you know, foster, you know, some of, I mean, they're trying to go after so many different behaviors. So it's hard to say. It's like the Shopify thing is like they're, you know, they're peeling off a piece of the Stripe area. And then they, you know, are obviously also trying to do this everything app, which would be more of like a social payments type thing. But Peter, how do you think about all of these different segments? So we've got, you know, payments to businesses, payments between people. We've got US, non-US. Like, how do you think about all these different segments, and what will be the make or break for the different chains and going after, each of them?
Yeah, sure. And I would say there's many different types of, you know, stablecoin type transactions, like in addition to, you know, retailer or front ends, and then, you know, what happens behind in kind of like middleware and back ends. There's also just like financial transactions, right? Like if you think about the number of dollars that exchange between JP Morgan and Citi and Fidelity and Mizuho, right? Like constantly, like that is a totally different type of rail and transaction and distribution network that, you know, that is needed. So, you know, and something frankly, like I'm not sure Stripe would or would not touch. So I think how we think about it is that, you know, from a top-down level, you know, the trend of kind of like stablecoin dominance is inevitable. Like personally, I see stablecoins as like right now probably like the killer crypto app more than anything. I mean, already, you know, the market's like over doubled year over year. It's like almost 280 plus billion. It basically, you know, stablecoin issuers hold the, you know, debt equivalent in US Treasury bills of like a top 20 nations, you know, sovereign. So, this is only growing. And I think, you know, Jon mentioned earlier in this conversation about kind of like why it hasn't happened yet and privacy. I definitely think there's like, you know, elements to that. And, you know, I'm not going to get into it technical discussion with Jon because he'll run circles around me in that respect. But I know markets and finance, and I know regulation, and I think like a lot of it, frankly, just comes from like what could you do or not do, right? And like when I was at Fidelity, we would constantly be having conversations with everything, the PayPal's and all like the traditional financial players, and like everyone's working on this stuff, but no one feels comfortable enough, like they have the green light to go out in the market, right? And I think Genius Act changed that, which was a little over a month ago, and I think it finally hit the U.S. that like, okay, stablecoins aren't a threat to the dollar as the global reserve currency. It's actually like significantly helps us maintain, our stature as the global reserve currency. And not only that, like, because they're backed 1-for-1 with U.S. Treasuries, we have a natural buyer of our debt that could like eclipse Japan in the next 5 years, right? So it's like massively beneficial to the U.S.
So before we move on from stablecoins, I just wanted to ask, like, if we're going to see, these new stable chains cropping up, what do you think that means for the existing general purpose chains that currently host the majority of stablecoin activity, like Ethereum, Tron, Solana, Base? Like, do you think that matters? Does it not? Like, what does stablecoin activity start looking like over there? I'd be interested to hear what you think the impact of all these new stable chains will be on these existing chains.
My general gut is, at least for the stuff that's there right now, it's probably not going to matter a ton. That would be my general guess, at least on the short to medium term. Like, I don't think that ARK is going to launch and then all the USDC is going to leave Ethereum and then go to ARK chain. That like everyone's going to start using that right away. Like, sure, some people will on the margin, people do it, but like I don't think you're just going to see this kind of overnight shift. My guess is what it matters much more for is just who is actually going to end up getting the future use cases that are coming. And I think that you have to like pretty reasonably shift your underwriting of where do you think that, all of the consumer payments and B2B payments and user savings and whatever are they going to happen? Are they actually going to happen on Solana and Base, which you might have thought like a year ago? Or do you increasingly think a little more that like, oh, actually, instead of, Base, maybe a lot more of it happens on the Stripe chain instead. And instead of, some of the stuff that was, would have been Tether payments, otherwise on, if Tron kept expanding, like maybe those go to Plasma or a stable or like some other chain. Like that would be my guess, is that it matters a lot more for just kind of assessing who's going to get the future use cases, but you're not going to see this like overnight exodus when these chains launch. The thing is, I think that the future use cases, I think most of us would probably agree are the much more interesting thing. Like this, we're going to grow orders of magnitude from here, very obviously on stablecoins. And so the future pie is the really big pie. And my gut is like some of these new ones are going to be very successful and will have very, very large user bases. And be able to lean into the distribution they have, the technical advantages they have, et cetera, to really drive a lot of growth.
So you already mentioned Pay and Tempo, but like, are there any others that you feel like have, good odds of succeeding?
ARK is the one to me after those that like feels the most intuitive. Of like they probably have some more interesting levers to be able to push as like they are the native issuer, and like it will just feel natural of oh, you're sending a USDC transfer, you're saving a bunch of USDC or whatever as a SEX, and where do you maintain that? Like it probably just it just feels right to like keep it on ARK chain because like this is the native chain and like it seems simple, and like if you screw up they'll probably roll back the chain for you anyway in size. So like those things around the edge will like probably matter, of just like honestly just a branding and psychological thing. And then my guess is like they're clearly going to try to like make, I mean, one of the things that they called out, for example, like making on and off ramping really simple for like fiat to USDC, like trying to make that really instant. So I think if they like really nail the infrastructure around it and get of like really good on and offboarding, and then also trying to really get a wedge into interoperability, which they're like very clearly trying to do. Those are probably the wedges that like ARK can lean into. But my guess is they're not going to like go in there and win on like degen DeFi and like start getting all the lending protocols to go there and like get all the hedge funds to move over. Like that's probably not going to happen. It's really nailing a lot of the infrastructure around it and the boring stuff. I could see ARK doing that if they execute very well, would be the most natural one. After that, I think it's like pretty normal BD, whether it's Plasma, Stable, Codex, Noble, They're doing the same BD that like Base is going to be doing and Solana is going to be doing, just in a very concentrated manner on specific use cases. And so, frankly, just if you have the best BD team that's like focused on a specific stablecoin use case, you have a good chance of winning out. Versus if this is one of the like 10 things that Base is clearly focused on, because they're also spending a bunch of time thinking on like creator coins and just like random DeFi and stuff like that. So if you're focused and have good go-to-market, like you could just win those things. But that'll be very much just who has a good team that executes is my guess.
Yeah. Peter, what about you?
Agree. It's not overnight, right? Like, this is not something that we're going to see immediately. I think, longer term, and whatever that means, right, is definitely the more I think interesting play. And that's going to take, time, because you're talking about, kind of like back end, infrastructure. And I think there are going to be, potentially many winners, and like any other like growing industry with a massive TAM, like you're going to see consolidation and you're going to see new entrants, and those new entrants form partnerships. It's I can't tell you exactly how it's gonna unfold. But I think there will be, potentially many different like stables, some that are used in kind of like, entity to entity transactions, some that are used kind of like natively on backends where you don't even necessarily know that you are in a different stable if you're in someone's environment, right? So say asset manager XYZ, you're on their brokerage platform and you put in, you deposit USDC or USDT or any stable, right? They could convert you to a tokenized money market fund, and it's all the same thing, but to them now their AUM is different. But as long as everything is like fungible, quick, cheap, I think that makes a lot of sense. There's others, right? Like, I think in my opinion, like, an entity like, and I'm sure there's others that do this, but like One Money is trying to solve an interesting problem where they have, like paying gas and like any native stable, and you might have different different stables that you're using in different jurisdictions or different countries, and just kind of going through that process of creating a technology that can interact across different networks, I think is probably interesting, and a problem that's not new to solve, but perhaps new to think about in terms of stables. But yeah, it's not going to happen overnight, but I think the go forward opportunity is, it's massive.
Yeah. Okay. We're going to switch topics because we wanted to talk about Hyperliquid. And, shortly before we started recording, it was revealed that Hyperliquid's July trading volume was 330.8 billion, and it exceeded those of Robinhood the same month. And John, I saw you tweeted that this is the first time we're seeing an on-chain competitor to centralized exchanges. So I wondered if you could just both talk about what it is that you think we're seeing right now, like what this inflection point means and where things could go from here.
Yeah, like the summary of it for me of like being the first credible sex competitor is like I feel like the meme that most exchanges have had over the last 2 years have been like, we're going to kill Binance. And that's always felt realistically to me like it's a little bit of a meme. It's a story that you tell, but like, all right, come on guys, like this isn't going to happen. I would say after the pump launch was the first time that I sort of had the like actual just kind of click of I actually think this is just going to happen. It's just a matter of like, when does it happen, what does it look like, and who does it. And obviously Hyperliquid's like the top competitor for that right now. It's very clear at this point. They're very consistently growing, just doing serious size. Obviously they've been doing it on perps, and now they're doing it on spot. But it's kind of crazy to watch an on-chain product do finally. They're fully handling in size the price discovery pre-launch of like multiple major tokens now in a row. They led all the price discovery for Pump. They did it for World Liberty. They did it for Plasma. These are tokens that aren't even launching on their chain, and they're doing hundreds of millions of volume on the pre-market perps. And that's actually what's doing the price discovery, not when the token actually launches. So perps, they're just consistently growing, and it's just a great product. You use it, and then you sit down and you try to go use perps on most other even sexes. It's just better from a user perspective. It's super liquid. It has a level of just Lindy and reliableness at this point. And then the one that's super interesting for me to watch over time that I really want to see play out, and I have more questions, is on the spot side. The last week was the first time that they have done really crazy stuff on spot where they were just like flipping Coinbase and Bybit on spot volume for the majors for Bitcoin and ETH, which is like pretty crazy. And most of that was driven by like one entity. It was some whale who clearly just bridged over billions of dollars of Bitcoin using units bridge to Hyperliquid. And they were like mostly just like swapping Bitcoin to ETH. I mean, in various forms. They were doing some spot, some perps, some on and off. But they were doing like billions of dollars a day of like actual spot volume. And so to the extent that like you start to see this keep happening and like you play this forward as they turn into particularly like clearly a more platform model where they're, exposing to, go build a new front end on top of it, which like obviously Phantom is doing with their perps of like, why would we go build all the back end infrastructure? We're just going to like bring the users and plug into this on the back. And then like, great, we'll have like a nice mobile front end for this. And then moving from that. And then so like actual permissionless market deployment on perps. Which they'll like have coming soon. That's where you get like a very clear edge and growth area again. They're just very clearly like they're going to be the first to list markets. They're going to be the most liquid markets on these things. And the permissionless listing is going to allow them to go into a lot of areas that like most of the incumbents are not going to go. Like Coinbase is not going to go list S&P 500 perps tomorrow because like they don't even launch regular perps right now because like even that's still a regulatory gray area. Like the perps that they launched they're like 5-year dated futures. Like this is what on-chain global products are supposed to do. So they're supposed to be first to market. They go launch the thing and then like we figure it out later. And they're going to be the first to market to launch all of these kind of different products and like keep growing in that way. And so you're just like seeing this trend now over the past couple of months where they're doing crazy volume on perps to the point where like they're just like they're great at it. Like you don't have as much reason to go use a sex. And if they start to like really push into spot, that will be like very meaningful. And a big part of the like impact to the industry part, I think, will end up being a lot of the sexes, particularly Binance, frankly, are like rather extractive, particularly for early teams. If you're like trying to get a token out there and like you want to get liquidity and people to be able to access this, the terms, if you talk to like anyone who goes through that process as an early stage team, is like they come out of that process generally pretty jaded and like pretty unhappy. It's not a fun process, and they will try to extract like as much of your token as possible, and like teams will feel stuck. To the extent that you actually have an on-chain version, which is just go permissionlessly launch your token and like we have all the users and the liquidity anyway, like screw the sexes, that will like actually pretty radically change the market structure and the ability to launch good projects like on good terms. So that's the part just like at an industry level I think is like super, super valuable. And I really genuinely want that to happen. And I am hopeful that we are like finally getting to there because there hasn't been an on-chain product that has like credibly been able to kind of offer that previously.
Yeah, that when you were talking about Binance extracting to list tokens, Peter had a wry smile on his face.
Yeah, I mean, anyone who's spoken to a founder who has gone through that process, like no one's happy.
They know what they're doing.
Yeah.
Well, Peter, what are your thoughts seeing Hyperliquid do these volumes?
I think it's great. It's a great product. It's great for the market. Creating competition is very healthy, and I think there's a lot that Hyperliquid is built and is continuing to do that is like very much to the Web3 ethos. Personally, like one of the things I really just love about this space is the thought process that can go behind structuring the economics of a token and how that token fits into the business. And I think Hype has done a really smart job there, offering it as kind of incentives and buybacks and then staking to earn additional rewards, right? It's something that you can ascribe like fundamental value to, which is ultimately what even though the market might not always do that, like I always tend to think about that and look at it. So I think it's great, like that you can combine that to it. I think, like frankly, like Binance's token was very smart in the way it launched much the same way, right? So I think it'll be interesting to see. I totally agree with John. Like, perps is one thing, and it's big, but it's very crypto. Like perps, they don't exist in like other markets like they exist in crypto. So getting into spot, truly competing with centralized exchanges, it's going to be fascinating to see. But ultimately, I think it's a great thing for the industry.
Yeah, I mean, it's also interesting just because of the like no KYC bit. So I think there's going to come a point where, the way they're competing with each other, I think is going to change.
Oh yeah, I was just gonna say, on the no KYC thing, I mean, this is one thing. I mean, like we need to see like where do the bills end up, where do regulators end up? But I mean, this is something that like actually potentially is and like should actually be a sustainable moat for a truly decentralized protocol. And this is something that like people will obviously argue. I mean, everyone said that Solana is central. All the Ethereum people said that Solana is centralized, and now most of the Solana people will say that Hyperliquid is centralized, and so on. Like it will end up mattering what is the exact definitions of these things, because to the extent that something is considered a decentralized and mature system, you just like you actually won't be able to KYC, and you won't have any requirement or expectation of doing so, which makes sense because if this is like there's no requirement for like Ethereum to KYC you, because like that just like obviously doesn't make sense. And so like where the language ends up on these protocols of like who is required to, if anyone, like actually take your identification or anything, it like the details of that will matter, because that should be a durable advantage to decentralized systems over time is, hey, if this is actually a decentralized and non-custodial product, like there isn't someone to KYC you at the end of this. There's no KYC process for me to send you ETH. And so it's the same thing for like doing a swap. Should Uniswap have to KYC you? Like this is obviously been an argument over like past couple of years. Like who's responsible for this? Is this a thing at the front end? Is it what entity who's supposed to do this? So that may end up being a durable mode, but like it's going to very much depend on like what are the bounds on what these systems end up being defined as.
I mean, that'll ultimately depend on like what you're doing there, right? Because there are certain types of assets that you need to be KYC'd in order to transact in, right? So, ultimately, yeah, it might not fall onto Hyperliquid, but, like if you're an SEC registered RIA and you're trading, assets that you're not supposed to be on, that's going to come back to you. Like the SEC is not going to be like, well, it can't go after Hyperliquid. So, so I guess there's nothing we could do. Like it's,
Yeah. All right. Okay. We're going to move on to the last question that I just wanted to ask you guys, which is I've been seeing and also participating in some debates about, what is going on right now? Like, are we still in this 4-year cycle kind of phase? Are we transitioning to something else? I can't remember who this was, but right before recording, I saw somebody was like, it's not 4-year cycles anymore. It's 8-year cycles now. It's like, okay, I don't know how you came up with that number, but, I was just curious, like, what you think is going on in that realm. And then whether or not we are in this cycle, we're at least in a phase. So it's a 2-part question. So we're at least in a phase. And what do you think this particular phase will end up being about? So anyway, 2-part question.
My like very blunt high level would be, yeah, it's dead. And the answer is no. I had a tweet along those lines yesterday I was like, CT keeps debating whether the cycle top is in. And my opinion is like, the premise is wrong. This isn't a cycle and there isn't a top. And like very literally, obviously there are cycles in the world. Like there's literally macro cycles to the economy. And so there's going to be speculative manias in crypto where stuff's going to go up a bunch, it's going to go down, fundamentals matter more or less at different times. Like that is obviously going to happen. I mean, that literally happens in the real world. What I think the problem is what people kind of like use that idea of a cycle to mean and like how they act on it. Like in particular, the way that you've generally invested and like has worked well in crypto in the past is you basically just bought a basket of everything. It didn't really matter that much what you bought. You waited 4 years and then you tried to sell everything as close to the top as possible. And then like you waited a couple years and then you bought everything again. And then like you tried to sell everything at the top. Like being very literal, that like actually was roughly a way that you would like pretty repeatably be able to make money a few times in a row. And so I think a lot of people just like over index on that too much of like, when is the top going to be? I need to buy all the stuff. And then like, I'm going to sell the top and then like, I'm going to go away for 2 years. And then like, we'll come back in a few years. And I think that's like very clearly just already dead, if for nothing else, for the simple reason of like, crypto is just no longer at all one uniform thing. There's like very clearly different segments that act like very, very differently, which is why you've seen for the past like 2 years in a row, Bitcoin just like keeps going to all-time highs. And like most of crypto Twitter is like depressed most of the time because like they don't own the Bitcoin. Like a lot of the institutions increasingly own the Bitcoin and like people who are not on Twitter. And so, yeah, if you were buying like meme coins and L2 tokens for the last 2 years, it's been a bear market. Like they're just like, there was no cycle. There was not much of like any upswing. It's just been like, everything's just been going down. Versus if you own Bitcoin, like everything's been great. Like what are you talking about? And so I think that is basically going to be the general trend going forward. We're going to clearly just like have a lot more dispersion in returns. You're going to have these institutional macro assets that are just going to like act very differently. You're going to get increasingly projects that like actually have good fundamentals and real world utility. And those are going to act more in line with like, how do macro cycles work for the real economy? Like, what are the cash flows on this project? Like, what multiple am I ascribing to this? How much is this thing going to grow? They're going to act more in that line. And then sure, you're going to obviously have like speculative bubbles along the way, and like meme coins will pop off, then NFTs will pop off, then some creator thing will pop off, and those will go through different little cycles. But applying this like one uniform framework of just like, we're going to try to buy all the stuff, and then like we're going to time the top, and then like we're going to sell it, and then we're going to kind of go away, and like this is the simplistic model. It's just like very clearly already dead in my mind at this point. Of like, this is just the market. You should just buy good assets, and like that's just like how you invest.
Yeah, I agree with that, Peter.
I mean, honestly, I think it's silly. Like as crypto becomes more like ubiquitous with traditional financial markets, and they become bigger and more diverse, like it'll look more like traditional financial markets. Like no one talks about, everything is cyclical, right? So it does depend on your time horizon, right? Like, so do I really care that I, owned ETH at 4,000 and 1,500 and 3,500 and 4,000? No, because like it's going to move around. And if I like an asset, I think it's going to be higher in whatever my personal time horizon is. There might be people who trade with very different time horizons, but like the whole nonsense of like, 4-year cycle, and you can play this, like people like to put things in boxes and it makes them, comfortable. But in reality, like that's not the way any financial market works. So as crypto, becomes more like real financial markets with large institutional players and more capital, like it's going to, kind of more resemble that, which I think ultimately is a very healthy thing.
Yeah. Okay. Well, it's been so much fun talking to both of you. Where can people learn about you?
Yeah, I mean, you can find me on Twitter, I guess. I don't tweet a lot, but maybe I'll start doing more. And then, we, on our website at hack.vc, we definitely put out, content and educational pieces. And, some of it tends to be much more technical and some of it, more financial in nature. But, it's a good resource.
You can find me on Twitter too. Like probably half the people listening find me on Twitter anyway, regardless of whether they want to see me on Twitter or not. Or you could go to dba.xyz, where we have a little bit nicer content that we put there too.
Yeah, John, for whatever reason, you are a divisive figure sometimes. I don't know.
No idea why.
Anyway, okay, you guys, it's been so much fun. Thank you so much for coming on Unchained.
Likewise. Thanks, Laura.
Unchained is produced by Laura Shin with help from Matt Pilchard, Juan Aranovich, Margaret Curia, and Pam Majumdar. Thanks for listening.